Welcome back. You're with us on Trading Hour, and on this leg of the show for some fundamental viewpoints in the market, we have Maneesh Dangi, founder of Mosaic Investing, joining in. Maneesh, great to have you with us on the show. Instead of the macros, I'll focus a little on the micros to get a sense of whether that could have any bearing on the market. And I'm referring to, this heightened RBI scrutiny and, some very, very strict actions that are coming in the last 48 hours or so. And I'll just update you because the news flash came right now. IIFL, for instance, IIFL Finance has now said that one of their investors, Fairfax, will be putting in 200 million to ensure that there's no liquidity event that gets created because of the regulatory action that's happening. Now, it's not too long back. I'm not comparing anything, but these things have a way of kind of tipping over very, very quickly. We all remember 2018, right? But just what do you make of things, given that RBI is literally out there to put any errant NBFC on the leash? What potentially can we be looking at over here? Or do you think these are small, isolated instances which will be ring-fenced and the market moves on? Right now, we even have midcaps correcting, and it all seems to be interconnected.
So a couple of things. It's not like 2018. 2018 expressed itself, so to say. It was endogenous, so to say. The NBFCs were growing too fast and ALMs were dislocated. So in some sense, RBI was behind the curve. And the key learning from that, of course, is that, RBI ought to do something ahead of, any big mess in any of the financing systems, banking or non-banking. So it's a typical, very orthodox RBI reflex that anyone observed RBI over 25 years, that in sort of relatively good times, they get to, prick these bubbles in small little way, only hoping that it doesn't become a macro event. So my sense is that these are pricking certain sort of business modules, so to say, for a lot of these non-banking and financiers. But I don't think it's something which can turn into any major 2018-like setup.
Maneesh, yesterday the announcement came that the Indian bonds will be included in the Bloomberg Emerging Market Bond Indices from January of 2025. Your initial thoughts on the kind of inflows and what follows next?
So the bond demand supply dynamic, for bond watchers for a good 25 years like me, it's really been as good. And of course, it's a new addition to anyways, otherwise looking like a demand supply dynamic where demand is likely to outpace supply over the next couple of years. I wouldn't be surprised if almost somewhere between 0.5% to 1% of GDP worth of bonds are taken out by foreigners, both through index buying, but also, lots of people who would like to be overweight given India's absolutely phenomenal fundamentals as far as bonds are concerned. Valuations are great. India rarely offers this kind of real yields. Right now, real yields are close to 3%, higher than, of course, what you're getting anywhere else in the world. And a great demand dynamic also because lots of insurers, pension fund buying, and of course, post-SLR regime has actually stabilized and banks have become active buyers. So, I mean, all of these things are sort of coming together to assist this general view that, Indian bonds will rally sort of pretty significantly over the next 12 to 18 months.
So what's the expected, boost, active and passive investing included? If you include both of them, because you said foreigners perhaps may want to go overweight now. So in your own assessment, what are the kind of inflows and what would be the bond level now that you would have on your radar now?
So as I said, 0.5% to 1% of GDP. So, I mean, I wouldn't be surprised you have on a, let's say, $4 trillion economy on a run rate basis, would you get $35-40 billion of total flows run rate, basis in next 12 to 18 months. So that's the kind of flows I'm looking at. And last time also we discussed about bond yields. I think in this cycle, we will pierce COVID lows. And so therefore, I think, it'll be below 6% at some point in time. Right now, bonds are where they are, with sort of very buoyant growth conditions. If cyclical slowdown were to sort of kick in, it's very likely that these real rates, which are at 2-3%, will sort of slide to near 0%, and which is why I'm comfortable calling it out as, something below 6% over the next 12 to 18 months or maybe 2 years on bonds. And, if you invest a 10-year bond at current levels, and if they were to rally to 6%, the holding period return for an investor is going to be close to double digit. So that's a pretty neat deal for a sovereign bond investor.
Sounds good, below 6% and a sweet deal for foreign investors. Maneesh, leave us with an outlook on equities. And I mean, typically low yields is something that even the equity market loves, but then there's this whole debate around what's happening with mid-cap and small caps over here. So what's your equity strategy at the moment in the portfolio?
So on the equity side, very unlike bonds, valuations are stretched. We are like a peak valuation, peak enthusiasm. And of course, now, we're coinciding with a peak hawkishness from policy. Like almost actively, both RBI and SEBI actually are wanting you to dial down on risk in the system. So in some sense, this is not a great valuation macro setup for equity. And last time also, I sort of called it out that very likely over the next 2-3 years, the equity premium won't be available for investors. I mean, you will have near 10% returns in bonds, and that's a very high probability. Whereas equity sort of would struggle, and the risk premium which you should get in equity, 3-4%, you really won't get. So I wouldn't be surprised actually if equity sort of under delivers versus what investors are expecting right now.
Maneesh, thank you for joining in, batting for the Indian bonds over equities. We'll get into a break. On the other side, we'll be joined by Lalit Khaitan of Ramkrishna Forgings. They recently held an analyst meet, so we'll discuss the way forward.